Hi there. What I have here is the recording of my conversation with Raman and Rajesh Sehgal. Both of them have done something very unique. They have worked both in public markets and now in the private market space. This makes for some interesting insights. Before we proceed, I request you to subscribe and then press the bell icon. So, good afternoon. I have with me two very interesting people who have something extremely important in common with each other. Before I get to that, let me introduce them. The first person I have is Rajesh Sehgal. He finished his education, management education from XLRI way back in 1996, I think, and after that worked with SBI Capital Markets. The most important thing that he probably did was switched to Franklin Templeton in 1999 and where he worked for around 17 years, I think 17 years. And after that, he started his own venture, a venture capital firm called Equanimity Investments. And he's been doing that for the last 3 years. The other person that you see is Raman. I know him for a very long time. He finished his education, I think, in IIM Ahmedabad way back in 1992, 1991,
Yes,
92. And since then,
92.
he's worked in various firms, but the most important I would think is CSFB, and then in as head of securities in HSBC Securities. He then has gone on to found a FII called Tricolor India, uh, sometime in 2005. Am I right? 2005, I think. And then after winding that up, actually started Lastaki Advisors and now also runs a private equity firm called Triton. So welcome both of you to this conversation with me. Uh,
Hi, thanks for having us.
Thank
uh,
you, Mary.
yeah. So I mean, the first question I think I would put is to Rajesh Sehgal. You worked in Franklin Templeton directly under Dr. Mark Mobius. I mean, who is probably a huge name in finance. Everybody knows him. And so the obvious question is that what were the learnings? How was he? How was it to work under him? Anything that you would like to say about all that?
Lots to say about that. When you spend nearly 2 decades working with someone and not just him, but the entire team, I think there's lots that you can share. But let me keep it short and to the point. I think working with him has fundamentally changed and shaped the way I think about investments and about generally about life. He's been a huge inspiration to the way I work. I think one of the things that stand out when you work with him for all these years is the work ethic and sticking to the knittings, right? So I've never seen him in all these 20 years that I've worked with him drift. So, there's all these consultants for funds will ask you about style drift, etc. I never saw that. And also very balanced, given his reputation, his fame, his stature, and the amount of assets, AUM that he was managing. I think he's one person who was extremely down to earth. So one of the learnings, and I get that as feedback, from some people here and there, is the whole thing about sticking to fundamentals, being very humble, and always trying to learn new things, whether it is private markets or public markets. I think it just you spend 20 years. I've been married for 20 years, by the way. So when you stay with someone for 20 years, they shape you up. They do.
Yeah.
So it's been an important part of my life. By the way, just to conclude that, so he's
Yeah.
still part of us. He's an investor in Equanimity, and he's also on our board. So
Okay.
the association continues.
Yeah. So it's been actually 2 decades of association with him. Yeah. So in Franklin, if I remember right, you actually did both public markets and private equity markets. So public
Yes.
markets was really not just India but also emerging equities. So
Mm.
you worked in public equities in India and emerging equities. Private equity was pure mainly India, I guess. I don't know. I am assuming it was mainly India. So how was that experience? I mean, how did you manage to do both those things? Was there an underlying template which was similar, or okay, let me put it this way: was there? What are the similarities, and also what are
recording. Okay.
Yeah.
So right, Mahesh, I did cover public markets as well as private markets, and because I was part of the emerging markets team, most of the time the role was about investing across emerging markets. It was never about focusing on any one country or one market. So even though I spent all my life in India working out of here, it was always covering assets across other markets, both on the private side and public side. In terms of the approach from so the whole let me step back and give you why we started this private markets and how the private markets group, the private equity group, integrated itself into the broader umbrella of the public markets business that Templeton had in those years. So the thought process actually was very clear: is public markets allow you to understand breadth of the markets. So, for example, if you have a steel company in India, how would that compare, or how do promoters, management, shareholders, all these entities, how do they behave differently in, say, China or Brazil or Russia, Eastern Europe, other markets, similar industries?
Yes.
So it was a good peek into comparing. Whenever before we would invest, we would compare across emerging markets and see what assets, how they are priced, and what works best. On the private equity side, the approach was slightly different, because it was not just about comparing across emerging markets, but it was also understanding what drives the business, right? It was a much more deeper look into the business. So the difference would be like you're driving a car in public market investing, and here you're really opening the hood and trying to understand what's inside. Given our approach at Templeton, even on the public market side investments, we would really try to understand how the fundamentals of the company are, what makes it work, what takes, what doesn't work. So there was a lot of fundamental driven investing that we did. It's a whole value investing approach. But the private market exposure really opened my eyes in those years, and I think I have a lot to thank for being part of that private markets group, because it really made you ask questions about how does management decide? You have so many things happening around you. What triggers business? What really works? And if there's a failure, because things don't always shape up well, right? How do managements manage it? So I think it's different. You learned when you were doing public markets, very different than when you were working on private assets and private equity investments. But I think there is a point where they meet. So the basic approach to understanding the business remains the same, right? The same driver, the same triggers. Only thing is, on the private side, you are working with the management to address problems that happen on an ongoing basis, which on the public side, neither is it required of you, or nor do you have the bandwidth to do it. So in that way, I think it was very complementary.
Okay. In fact, I would like to also know the views of Dave on this, because he's done Tricolor, which was actually a hedge fund, which he started in 2005. In a roaring bull market, you started a hedge fund where you might have been required to short also. Was that in hindsight, was that a good thing? So I was asking basically this question, that you started this hedge fund in 2005 and 2005, 2006. What was your experience in that vis-a-vis the Triton private equity thing that you were running? And again, in that hedge fund part, there was a sub-question, subtext, which I always wanted to understand. Was shorting at that time a bad idea because it was a roaring bull market?
Well, yes, I mean, it was. We were one of the first real long short funds in India.
Yeah.
I think shorting was probably a very new concept to the markets. But India, always had single stock futures, which is quite unique as far as emerging markets. Actually, quite as far as markets go, I think the extent of single stock futures that we have traded on the exchange here. But the whole idea of shorting, Mahesh, of course, if you are in a bull market, you often wonder why you're bothering shorting. But I think, as a hedge fund manager, you're always evaluated against market exposures, and you're evaluated against, the volatility of your returns and things like that.
Yeah.
And India, because it had such a wide swath of stocks to short, gave you very good opportunity to own the stocks you wanted to own and have an interesting portfolio of stocks you wanted to short on the other side, which kind of allow you to produce very good risk-adjusted returns, so to speak.
Yeah.
And I think, I think it was a very interesting experience. And I do think that is a product that has a place in every market. And it's probably something that needs to be embraced openly across emerging markets as well, I would think.
Yeah. So and then running a fund like Triton, which is a private equity fund, I mean, which is completely different from what you did in the past in terms of the public equity space that you
Yeah.
were in. So how do you manage to do these two kind of very diverse kind of activities?
Well, funnily, there is one big similarity between the two types of funds. In neither case are you trying to actually beat the index. What you are trying to do is produce good, steady, positive returns. To that extent, it's similar, but the similarity, I think, ends there. I completely agree with Rajesh that, the fundamentals of investing remain the same. The way you look at companies and the way you understand them remain the same. But I think the similarity, again, kind of ends there. In a public markets environment, investing in the context of a market.
Yeah.
And, very often it's you're investing. I mean, your bigger relationship is often with the market rather than with the stock itself. Very often, and hopefully that's becoming more true, you don't really know the managements you're investing in at a personal level. You're, looking at a lot of public data and responding to that. In a private environment, the relationship is a lot more bilateral between you and the investor and the company.
Yeah, which is
Really taking a call on a company. And often you are actually able to work along with the company in whatever form you're able to add value to kind of improve returns for everybody.
Yeah.
And, as you know, increasingly with regulation in public markets, you don't want to be too close to a management. And you want to kind of, keep that, which is the right way to go in public markets. In private markets, the relationship is extremely different. And the one other thing that I find very interestingly different in private markets is that in public markets, your universe is finite. And, especially when companies are raising money, all fund managers hear about it and everyone has exposure to it and everyone can take a call. In private markets, often your ability to find companies and source deals is very critical. So the market is fairly opaque. It's really what you are able to go and find. Of course, there are bankers and intermediaries who bring deals. But as I'm sure Rajesh would agree that a lot of investments you make are companies that you have identified, you have kind of seen something special in them, what we call proprietary deals in that sense. And therefore, sourcing becomes more important in private.
Okay. That's a huge difference, actually. That's a big difference.
Just to butt in there, I was having a conversation.
Yeah.
So just to button on this point, Dave, I was having a conversation with one of my team members last evening, and one of the things that he discussed was, so he's a pre-MBA, right? He was like, should I go into an MBA or not? And one of the things I asked him, why do you want to do an MBA? He says, look at your network, right? Most of the investments that we are seeing are coming through a network, and when you go and do an MBA, get an MBA, you get access to a global network. And he actually, I had not thought of it that way. And he actually recounted. He said, this deal is come from your Water network. This deal is come from your Excel network. This deal is because you're with Mumbai Angels. This is the tie network. He actually set up all these things. And I say, that's true.
Yeah.
So I think to Dave's point, yeah, proprietary deal flow is extremely important. Yes.
Yeah, that I didn't think of it this way, but it is actually very true, isn't it? I mean, in public markets, it is really about your ability to understand which sectors, which companies, top down, bottom up, whatever, but your ability to pick these which everybody else can see too. I mean, they have the equal opportunities to get in, but here there is a bit of opacity which can lead to networks and your proprietary ability to.
Sorry, not a bit of opacity. It's
No.
opaque.
Okay.
It's supposed to be.
Yeah. So then it is really
If you're
about.
careful,
Yeah.
sorry.
No, go ahead. Yeah.
No, I was. If you're not careful, it'll remain opaque even after you've invested in the company.
Okay. Okay. So since both of you are a product of these last 2 decades, one of the big questions is how did 2008 impact you? Uh, and I know that Rajesh was both in public and in private space at that time. So were there a difference? How did it impact? Of course, Dave was in public space at that time, I'm sure. So how did that happen? What happened actually?
I think so. Yeah, the impact was felt on both sides, on the private side as well as the public side. For public markets, it's where data is all out there, so we all know that markets really crashed and they came back very quickly.
Yeah.
Similar to I think what's happening now under this COVID scenario, where it just crashed and then everything is back up, right? I mean, mostly. So I think 2008 was a big learning for all of us. That and thankfully we were long only funds. We were not shorting at all. I think the lesson that markets learned is never stand in front of a tsunami created by central bankers. Like never stand in front of that. So I think on the public side, we felt the impact for about 4 to 5 months. I think after that everything was back up again, and assets came back to how they were. But those 3 to 5 months were really strenuous because it made you ask all sorts of questions. It made us ask every holding in the portfolio of why do we have it there in the first place. Our conviction on the whole portfolio was actually questioned. So there was a lot of learning on the public side. On the private side, because the price, so there's a big difference between private and public. Basically, is price. On the private side, price discovery doesn't happen minute to tick, and so therefore you are shielded from immediate impacts. So on the private side, we anybody who saw an impact was because the business suffered, right? And I think that's what's happening now itself, Mahesh. Under the COVID scenario, stock prices on the public markets have gone up, but the impact that this COVID or any these kind of pandemics have on businesses, that will be there to stay.
Yeah.
So in 2008, luckily for us, we had made some very smart exits. In hindsight, it was smart. 2006, those exits on the private side, exit is everything. If you make your exits right, that's I think 70% of proprietary deal flow, making the investments, working with the management, I think is the other 30-40%. So I think because of those exits, we were very lucky. Those funds did extremely well. I think just to share some statistics, so I was at Templeton for 18 years, did 4 private equity funds, for part of it. The first 2 delivered IRRs. The fund delivered an IRR of 20%, net dollar IRR.
Wow,
the second one actually did even better, 35% net IRR. So I think those exits in those years, saved us. But to answer your question very specifically, I think on the private side, the pressure, the daily pressure is not there. So only impact on the fund, on the portfolio will be public side.
Okay. So, and from your perspective, Dave, how was it?
Yeah. I think for me, I guess running a long short fund, the impact of markets itself was a little more probably manageable. But I think the I think that was a period which had was a kind of personal turning point for me, because in 2007, I remember I was having a conversation with the largest investor in my fund, and at a very personal level, I was actually beginning to wonder what I was doing every day coming into markets. And I was telling my investor that, we come in here and we price a Reliance or a Larsen and, on a daily basis. And how does that really make sense to anybody? And I was, but, when you're running a hedge fund, the opportunity cost of closing it down in a good time is extremely high. And, so you kind of continue doing what you're doing, right? So in some ways, 2008-9 gave me that opportunity to kind of think about what I really wanted to do. And I was personally getting pretty close to 40 at that time. And I can say that, look, I probably want to spend the rest of my career making a better impact on the companies that I work with. And that was the singular purpose with which I got into unlisted, and that too in kind of, earlier stage, where I felt that we could make a difference to the lives of a few entrepreneurs, and it's not about making a difference to the economy or the country or anything. I mean, we don't have such grand notions of ourselves, but I think in some ways, you write the first institutional check to an entrepreneur. And Mahesh, when I turned entrepreneur and set up a hedge fund, I remember that our first investor committed to us and then walked out, didn't kind of invest. And, at that point, my only wish and prayer was that I should get a chance to try my skills to succeed or fail as an entrepreneur. So actually, when we got the first investor, it kind of, meant that we didn't fail without a chance to try, and then we had a good run for a few years, which allowed us to kind of figure out if our methods in the markets work, etc. And I think today, in some ways, that's what we do to entrepreneurs. I mean, we give them the first institutional check. They get a chance to actually try their business idea out there with a little bit of capital behind them. And I think Rajesh does pretty much the same thing. I think it makes a very significant difference to the life of that entrepreneur. Even if they failed after they had a chance. And I think that's important.
Yeah, the way he puts it actually makes a lot of sense, right? Very true. In fact, this is one of the things that Rajesh touched upon a bit, and that is why I wanted to highlight that because people might not have got it. In the private equity space, clearly there is higher risk, as we all know, because it is maybe the liquidity risk itself, but there is some higher risk than the public space. And the question that I was going to ask, and which you probably have already answered, is that yes, the returns are higher or can be higher in the private equity space to compensate for the higher risk that the investor is taking. And in India, maybe we don't have that kind of long track record to be able to say 100% yes, SI hoga. But with your experience and with your knowledge of what has happened internationally, do you think that generally, on an average, with all those caveats, the private equity space actually compensates for the private higher risk that they take?
I want to come in here first. And, just caution all your viewers that, the returns Rajesh spoke about are not what they should assume as, assume.
To get,
I mean, that was clearly superlative performance. And I think that, look, like in every asset class, you have good managers and bad managers, and you have periods where every manager, in every manager's career, when they have a good run, and there are periods where things don't work the way you wanted it to. And that is true of public markets, that is true of private markets. So I don't think it's, of course, private markets should give you higher returns because of the liquidity, etc. But I think overall, they're just two asset classes, and people with a fair bit of investable corpus. I think both asset classes should form a part of their mix, because they kind of expose you to slightly companies at different stages, the different dynamics. One exposes you a lot more to the markets. So the different types of risk. And therefore, I think it's a tool of diversification more than anything.
True enough.
I couldn't agree more with you. I completely bang on. I think it's a tool of diversification, specifically in the India context, by the way. There's enough and more written on it, so I'm not going to spend a lot of time on it. But if you pick the top, performing funds in India, the larger cap ones, most of them have similar holdings. Right?
Yes.
So as an investor, you may think you've diversified because you have 5 different funds. But actually, like I said, if you lift the hood, you're really not diversified. It's all the same, right? So I think from a diversification point of view, specifically in India, having access or having exposure to private companies which are earlier in their life cycle stage, of a business's life cycle stage, I think it's extremely important, right? And very, very important. I can't stress more on that. So my view has always been, and I've been very vocal about it, that for any investor who has, a portfolio that, a high net worth investor or a family office, I think at least, 20 to 25% of your portfolio should have exposure to these kind of assets, which are not listed in the markets, right? And the quintessential question about, returns from private assets and versus public assets. I think, again, I agree with Dave that there's a time for private equity and there's a time for public markets when you'll see this performing better than that. It's like a question, which at Templeton we used to always ask, do you believe equity markets always outperform debt markets, right? Or a fixed income portfolio? On an average, yes. On balance, you would always say logically yes, but there will be periods in time, clearly go back, and those numbers are out there, where debt markets will do better. Fixed income will give you better returns because equities will go through their own cycles. Right? So to say that A performs better than B all the time, I think is not correct. But yeah, mostly you expect, like you, Mahesh yourself said, because you're assuming higher risk, your expected return is higher.
Yeah.
Right. The only way you will get access to that expected return is if you stick all through that cycle, whether in the public markets or the private markets. I think on the private markets, it becomes easier because exit is not there. You can't sell tomorrow.
Yeah.
So you are forced to, be an equity investor and by definition have a longer time horizon.
Correct. In fact, that was going to be my question, that because of the illiquidity part, which is considered a risk, this probably helps an investor to actually make the return that he should be making by investing for the long term. Because a lot of fund managers whom I've talked to have told me that while their funds have given a certain percentage of return, compounded annual growth rate return, say for the last 10 years, they know that not too many of the investors have actually even made that return, because they have gotten and got out at the worst possible time. So the public space allows you a lot of liquidity, and probably that impacts the actual return that the investor makes. So this part is true that it does help probably. But so what kind of investors should really, you did mention 20-25%. It's in terms of the amount of money that a investor could possibly put out of his total investable surplus into the private space. But is there a kind of investor that you really look for in this space? I mean, Dave or Rajesh? Yeah.
Well, I think very clearly, because these tend to be 7 to 10 year type views that you take on a fund, and it's locked up or pretty much locked up for that period. I think this is an instrument for what you call high net worth investors, people who can, very comfortably put that money away for that period without worrying about it, and without needing it in the middle. Right. So I don't think, for example, people who are in the process of kind of buying their first homes, should be thinking about private markets, right?
Yeah.
But definitely, if you have a fairly large sum, and that number could vary, Mahesh. I mean, and regulators actually control this as well.
Yeah.
So even if you do an international fund, I mean, you have to get what are called qualified investors, have either a certain net worth or can invest a certain minimum amount.
Great.
In India, I think SEBI's restriction is that investors have to invest a minimum of 1 crore in a fund, which means that you have to have that kind of amount, that 1 crore, let's say, forms 10% or 20% or whatever percent you're allocating to private markets, right? I think the other thing is that, at least for me as a manager, I was very clear when we raised private money that people give me sums of money that were not a very significant part of their net worth. Just because I said, look, I mean, this is very liquid and I want you to be relaxed about it. And I want you to allow us to be relaxed about how we make these investments. Because these are, young companies, and we want to give them the time to grow and realize their potential. So I think, again, the fundraising process in the private space is a very one-on-one process. You meet your investors and your investors meet you, and a fair bit of comfort needs to
be developed. Yeah.
Yes, between you and your investor, and I think that is very important, to be able to kind of give the companies the right sort of backing, in my view. I think it creates the environment where everyone can work towards growing these companies in the best possible way, and that will produce the best returns.
Great. Yeah. Anything you want to add to that, Rajesh, at all? Or...
Again, I mean, just a different way of thinking about it. So when you're buying a listed fund, if I invest money in a listed fund, I'm called an investor. Right? But when I invest in a private fund, I'm a partner.
Okay. Yeah.
Right? So the terminology itself reflects that it's a longer time horizon commitment. The managers are called general partners and the investors are called limited partners. But it's a partnership. It's that whole mindset. And I think it's extremely important, like Dave said, for people to have that 7 to 10 year time horizon, and to have the ability and the conviction that you will not have access to that money for an extended period of time. And in return, obviously, you expect that portion of your investment to give you a better return, but liquidity is gone. So the whole mindset is very different. As I said, it's about partnership, not investor.
Yeah. So, yeah, you want to say something? We can.
No, I said absolutely correct.
Very. Yeah. So, because both of you are private equity people, I can't leave you without asking you this very important question, and that is that which sector do you see the next multibagger coming from? Do you have any ideas on that? Do you think certain areas are very promising, or anything at all that you want to say to that?
I'm going to let Rajesh.
Sure. No, absolutely. So, see, I'll tell you. So I don't know whether I'm a private equity guy or a public market guy, because it's just. But in terms of sectors, again, let me step back of why I'm doing what I'm doing. Why Equine Ventures and why we are doing private equity and why we're doing early stage. So it is, my first angel investing happened in 2006, 2007. So I've been investing my capital, personal capital, in early stage companies since then. And the whole investment thesis that I had in my mind, I think it's played out beautifully well, and more so today. And I'll tell you what that is. So my belief has been that in a country like India, if you want to build scalable businesses, the one thing that is compulsory, it's a must, is that your capital efficiency has to be great. We are a poor country, and by poor country I mean on both sides. So demand is at a certain price. We are very, very value conscious consumers here, right? And on the other side, we don't have access to a lot of capital from a capacity perspective. So I think successful businesses in my opinion have been those who have really respected capital and made sure that you get the most out of it. Right? Now with that construct, if you put a layer of technology over it, and that has been our hypothesis at Equanimity and my personal hypothesis as well, is that technology allows you to scale very efficiently, right, from a capital efficiency point of view. So if you ask me what sectors will do well, I will say that India has so much to offer across different sectors, and this is something you realize only when you step outside, right? So countries, across emerging markets and developed markets don't have as diversified an ecosystem itself. So in India, you can, in the listed markets or in the business market as such, you can have scalable large businesses in the chemical space, pharmaceuticals, cement, steel, infrastructure, consumer, name it. I mean, all these sectors are available. Now, the beauty of this is across all these sectors, if you apply a layer of technology and make efficient, scalable, large businesses, I think the investment opportunity is awesome. So if you were to ask me, what am I very bullish about? I am bullish about every sector or every entrepreneur who can use technology to enable their businesses to grow rapidly but efficiently.
Okay.
Yeah, I think, I mean, completely agree with Rajesh. And I think today, see, actually, if you're operating in the space Rajesh and I are operating in, I guess you can't avoid talking about technology,
Yeah.
And one of the things that I see, look, the Indian investing story has gone through various large secular trends, right? So you had the opening up the economy in the early 90s. You had the uh, IT services boom from the mid 90s right up to maybe 2005, 6. Then you had the whole India consumer story maybe from 2005. Uh, and it's still in some ways going on. I mean, if you think about Maruti, when it went public, I think I was in HSBC and we were one of the people managing it in 2004 or 2003. I don't remember. I think it was such a small company at that point in time. It's quite amazing, uh, how much the automobile sector has grown over this period.
Yeah.
But I think the one big thing that today is happening in India, and which the listed markets give you very few opportunities to play in actually, is that India is beginning to become a user of technology. Back in the day, we always said, and to some extent, people still say that, look, there is no, you can't make money by investing in companies that sell technology in India, But if I look at, one of the big things that has happened is the onset of, let's say, the mobile phone has meant that every person with a smartphone effectively has a computer in their palm, right? Which means that to kind of roll out technology, it with employees or even retail consumers, you don't need any and stuff. I mean, you download an app and you've got technology, right? And because of this, in every facet of business, technology has started entering. And I think India will become a big market for technology. And I would hope, and it's our bet, but I would hope that that is a trend that's there will hopefully at least some part of that trend will be captured by Indian
Indian
companies.
yeah.
You know, it would be, yes, it would be, really unfortunate if the only people who made money out of this massive trend that is rolling out across the country, the only people who benefited out of that is foreign companies.
Correct.
And, one of the things I see, Mahesh, is that most of the capital available to these companies, and that is again something that I think needs to be corrected. I think that domestic capital should also participate in this trend. And I'm not saying this out of kind of, doing good or doing the right thing. I think it will produce superior returns. And Indian companies should actually participate in this trend. And I think it's not just in India. This is true across emerging markets. And companies, Indian companies, I think, understand technology that works in emerging markets better than Western world companies, because of the unique nature of certain problems. I mean, to give you an example, we invest in companies that are B2B or technology companies that sell to businesses. And if you look at the number of languages, a large company with a presence across India needs to kind of deal with, especially when it's dealing with technology that all their employees use, or the fact that a lot of your users are not comfortable typing in a lot of information into forms. So you've got to kind of make your technology a lot more icon-driven, graphics-driven. And these are interesting issues that countries with similar demographics like ours, and Indian companies have an opportunity not just to exploit the growth in India, but also a lot of these other emerging markets. And I think we will get a lot of multi-baggers out of these areas. And hopefully Indian capital will be able to participate in this trend.
So, we have discussed all this now in public market, private market space, etc. And we've generally talked about a lot of things, including which sectors you think will do well in the future. So I want to now, take a step back and actually talk about you people itself, about Rajesh, about Dev. So the first question which typically I ask people is that, would you have done anything differently in your life, in the last 2 decades, with your experience that you have now? Would you have done anything differently? Rajesh, this is...
Yeah, that is something, we keep asking ourselves all the time, right? I think conceptually, no. I think, it's just that I think, and I can't speak for Dev, but at least for me, the way I think is, it's just been that India opened up, like they mentioned, in the early 90s. And I think people like us have just been in the right place at the right time. We were blessed that India opened up when it did, and we were right there to capitalize on that opportunity. And we are seeing that trend. It's a unidirectional trend, right? Where we participated in our growth. And now you see this whole 200, 300 million, the mid-size, the mid-market India that people talk about. I think they're all participating in that growth now, right? So I think, would I have done something different? I mean, yeah, here and there a little bit, but nothing conceptually different. I think it's just, I'm blessed to be part of the investing community. I feel so blessed that I've been on the investing side all through, and more opportunities, then got participating in private equity, straddled both of them for all these years. Amazing from my point of view. And now I'm participating in this whole early stage technology driven boom that we are seeing in India and the world. So I think, I'm very happy where I am.
Fair enough. Dev,
Well, I don't know if I would have done something differently. But I think the difference that I would like to point out when I look at the way I did things and when I look at some of my peers and friends, you know, and some people stuck to one thing for, you know, let's say now, I mean, what's 27, 28 years.
Correct.
And that's been fabulous. I mean, they've done extremely well. They've achieved great success in their areas. And I definitely think that if you measure success by where you kind of, you know, your position in a market or in a company, then that's probably a very, and I would definitely say this to younger people starting today, that look, stick to one thing and it kind of pays off over time, you know, somewhat maybe similar to taking a long-term view on investing. But I think that on the other side, I've kind of had the pleasure, as you know, Mahesh, of being in stockbroking, running a hedge fund, being in investment banking, and then kind of running an unlisted fund. And, you know, and I've kind of seen this whole plethora of things. And that has had a very, very different charm. It's kind of shown me many different aspects, you know, right from the largest companies in the country to really small startups. And I've kind of had the opportunity, along with you, to have worked at a large corporate and set up a stockbroking company for them, and understood how industrial houses think and work from very, very close quarters, to watching entrepreneurs and their crazy dreams and how they think. You know, I just think that I truly enjoyed that. You know, so definitely for me personally, there's no regret in having walked this path. But there is definitely a different path that some people have walked, and very, very successfully.
Well said. Yeah, that is true. Which actually brings me to this question. The next question, therefore, is that for both of you, is this work itself your hobby? As in, you like it so much that there is no other particular hobby that you have? Or would you, like so many others, say that at some time I want to give it all up, go to a hill station, run a, you know, have a apple orchard or run a organic farm, or some people say a shack in Goa where I'll be a restaurateur or something like that. Are there plans like that in the horizon, or this is it? This is what you would like to do?
Well, you know, we've all now sat at home for a long time and worked here. probably told us that we could probably work as easily from Goa as and you know, and I think a lot of these things have been mine, because I've often felt that if you could sit in New York and from a very, very different time zone, money in India, then why can't you sit in Goa or Munnar or, you know, Nali
and do the same?
Sure, you can. I think as long as your investors are okay with that, and you know, you have a certain set of investors who trust what you're doing, you can do that. And I guess you know, that's something that I would personally probably love to do. But then, you know, to some extent, as I said earlier, this is a process of also finding your own deal flow. And, you know, therefore, to some extent, you've got to be in the thick of where entrepreneurial activity is. You know, Rajesh told me once that he kind of set up his office in Powai. Correct me if I'm wrong, Rajesh, but you set up your office in Powai because you kind of saw a startup ecosystem in Bombay, in that part of town, and which is very true. So I think, you know, but coming to the other part of your question, is this hobby? I mean, I think that personally, I'm very, very happy waking up every morning now and doing this. I've been doing this for 12 years now, and it's not always been easy or been the best parts, business wise. But I've always woken up very excited about what we are doing, and very excited about what companies we are working with are doing. And I think this is something that you could do as you get older. For example, stockbroking, which is what I did in the early parts of my career, I think is still a younger person's job. I feel, and I couldn't be doing that today.
So I think the answer is pretty clear that you will, whatever you do, even if it is from Goa, it will involve a part of what you're doing today, even if you do it from there. So Rajesh, you have anything else to say?
Yeah, I mean, all these ideas are very alluring. Going and working from a beach shack or setting up a chai tapri or a coffee shop in Ladakh, very alluring. I would love to do any of those. But I'll tell you what, honestly, I can't see myself doing anything other than what I'm doing.
Correct.
And that's the honest answer, right? It's like, it's the only thing. Let's look at it this way, very humbly. It's the only thing I know how to do, right? I don't know if I'll be good at running a coffee shop. I don't know if I'll be good at being an entrepreneur doing something else. But this is what I think I've done all my life, and for good or bad, this is all that I know, and I'm very happy doing what I'm doing.
So I think So please.
Walking into Raj's coffee shop may get less coffee and more advice.
You could have probably a finance cafe kind of thing where people come, especially only finance guys will come. Even set up a trading desk with a coffee shop.
No, I had some idea once, by the way. I used to play a lot of chess.
Oh,
and
yes.
The idea was to have a chess cafe, right? So you come, you play chess and have coffee or tea, etc. And I was very serious about it, by the way.
It's not a bad idea. Probably you will have a computer which will actually play, have some of the softwares there, which will do that. So ideally,
it needs to be very expensive for that to work.
Actually, the only problem is in these kind of ideas, which you have to have a set of people who are interested nearby. Even a bookshop with a coffee is, which has been done, I think. But then they find this problem that people around the place don't necessarily want to go there every day and actually have the coffee. So coming back to the final,
thing.
Sorry?
No, I was saying we've done crazy, and we should. I said we've done crazy enough things, and we really don't need to go as far.
No.
Finance.
Very true.
So, typically when fund managers go to a company or a research analyst goes to a company, he comes back and says, these were my takeaways from that. So one of the things I would like to do is also leave our viewers with some kind of takeaway. And the takeaway typically is not necessarily related to this, but with your experience, what would you want to say to a person who says that I have mutual funds, I have everything, but मेरे को तो stock करना ही है, मेरे को तो लेना ही है. I want to invest in individual equities. Is there anything that you would say that at least do this so that you avoid the big mistakes? Right? I'm not asking you to say things which will say कि ये करने से पैसा बनेगा, definitely, but ये करने से पैसा नहीं जाएगा बहुत ज़्यादा. Is there anything that you would like to leave our viewers with, some kind of screener, some kind of basic things that he should take care of? Rajesh? Dave?
Well, I think, look, single investing as an individual is a very tricky game. When you're not there is a lot of information asymmetry in markets. When you're not a fund, you are handicapped in many ways, because while people say that, look, information is available to everybody today on the internet, etc. When you're a large fund, when Rajesh worked in Templeton, for example, the best analysts around the world would have been happy to talk to him the moment he wanted to. And today, investing has an impact from so many global forces, so many things that are happening around the world, central banks, policy, all kinds of things, right?
Correct.
I think as an individual sitting in India, the game is very, very tricky. You may do everything right. You may buy the right company. You may do a lot of research, but there may just be things that were out of your reach in terms of information or understanding, right? However, if somebody has to do it, then I have only two really broad things to say. One is, as far as possible, stick to things you understand. And the truth is, most professional fund managers also do not understand most businesses.
Correct.
And there is no need as an individual investor for you to invest in every trend in the market.
True.
And the second thing is that when you're investing, your job is to make money. Nobody is saying make money out of these stocks. So if you don't understand internet stocks, don't invest in them. Don't understand pharma, as I don't understand pharma at all. I invested in a pharma stock because I don't understand it. And there is no need, because the universe is large and you can find ideas in what you understand to invest. And if you don't find ideas, wait till you find the right idea, and and try not to kind of listen to everybody else on how much money they're making and get swayed by that. Most often they're just telling you the full truth.
Yeah. Rajesh, anything to add
Yeah.
to that?
So I think I agree with whatever they've said, and there's no debating that point. It's extremely basic and very important. Just to give a different perspective and a different angle, I think I want to remind everybody here that investing remains a very serious business. It's a business where you are deploying your very hard-earned capital, and hard-earned money. So you have to take it very seriously. And a very simple thing that I would recommend all of us should do is to do something which I call know yourself. What I mean by this is, most of us who are deploying capital and investing money use this word investor very loosely. I think it will serve all of us well if we understand whether we are investors or traders, right? Are we really long term, or are we short term? Do we, like Dave gave the example of pharma industry, right? If you don't understand it, don't do it. And if you're doing it and you understand it, you're doing it, do it for the long run. I mean, there's no point in buying Dr. Reddy's today and selling it in 2-3 months and saying, I am a long-term investor. Equity markets don't work like that. So you have to know yourself, whether you're a trader, speculator, or an investor. And if you are an investor, then I would recommend diversify. I've seen, and coming back to the early stage opportunities that we see, and people around me who call themselves, angel investors. There's a blog I've written, by the way, on the difference between angel investors and I call money bags, right? People who have the ability to cut large checks, but are really not angel investors because they're not helping or working with the company in any meaningful manner. So you have to know where you stand, and there's nothing right or wrong about being an angel or a money bag. You just have to know where you are. And that said, I would also recommend, when you're investing in single opportunities on the private side of the business, I I don't think you'll diversify enough if you're an individual investor by buying 2, 3, 4 early stage companies. You really need to make sure that you are part of a fund, and you are having exposure to not only all the knowledge and the expertise and the professional things that the fund manager brings, but also access to a diversified portfolio. Are you really getting somebody who knows what's happening on the private side? We discussed earlier on this call about opacity in the market, access to deal flow. All of those things are part and parcel of a fund on the private side. And so I think a simple thing is, if you want to dabble on the public side, you're better off going to professionals.
Hmm.
If you're dabbling on the private side, I will highly recommend you be part of some network, some fund, and not try to do it yourself. It's a very serious business.
Correct, correct. Actually, I'll just share with you my own experience. I sell mutual funds, and mutual fund distribution is something that I've been doing now for 3, 4 years. And almost every investor, and I call them investors for a better word, they come to me and say that इस साल तो तुम्हारा रिटर्न्स बहुत खराब था एंड आई लाइक सो क्या खराब था तो एफडी तक भी नहीं बनाया तो एफडी तो 5-6% देता है यू नॉट आई मीन आवर फंड्स हैव डन नॉट इवन दैट सो एंड देन आई आस्क्ड व्हाट इज इट दैट यू एक्सपेक्ट जैसे एफडी से तो बेटर बनना ही चाहिए ना इक्विटी में डाल रहा हूँ तो ऐसे यू वांट समथिंग व्हिच विल गिव यू एटलीस्ट एफडी रिटर्न्स ओके हाँ एंड बेटर देन मार्केट व्हेन द मार्केट इज गोइंग अप सो कोई एफडी में डालेगा ही क्यों पैसा अगर ऐसा कुछ भी चीज है यू नो
But the problem is that, you know, mutual funds, equity investments have also been missold, right? And people have been told this, that mutual funds will make more than FDs, equities will make more than debt. And that's tough, which, all of us unfortunately have learned the hard way is not true, right?
No, because I think people kind of whisper on an average over a long period of time. They don't actually say it explicitly.
Fine print. But I think something else that is into sorry, something else to all of us is sorry about that. So something else that is creeping into all of us is a lot of short-termism, and especially if you're in public markets, because of and this is something Rajesh you one day that which I completely agree with, and Mahesh, I'm sure you would as well, that if you public markets, because you have to kind of announce results quarterly, and actually CEOs not only have to announce results, they have to get on a call and explain what happened to investors. And often it's very, very tricky to predict quarters, and it's very tricky to explain why a quarter went well, or quarter's too short a period, and therefore businesses, investors, everyone is thinking about shorter and shorter periods. Ideally, in private markets, you should be able to take a 2-year, 3-year view as a business and work more strategically. And it does happen. But it does worry me sometimes when I see young promoters telling me, I will make this happen. And it's something that is a very significant shift in their business. And they will say that, in 3 months, I will do this. And I'm like, how that happen, so I think, this is something that I think we've overcorrected on. And we're looking at things in a very, very short period now. And that is a problem.
Very well said. Yeah, I think it is a huge problem, and the more we talk like that, the more it seeps down to the investor, ultimate investor also, because he keeps seeing a quarterly number, and he keeps seeing a quarterly growth, and then he keeps wondering whether this is the company to invest in or not. This quarter, the results were not that good. Everybody sees CNBC or Z Business or one of those channels, and comes back with their own ideas. So it is tough. Maybe one of the other problems I see is that somewhere there is this dichotomy or dissonance between what is happening in the economy and what the markets are doing. And so to a certain extent, I think there is no sense of well-being associated with the rally that these markets have done over a long period of time. And that also is the problem for the investor being very short term. He's afraid that he's going to lose it all because he doesn't feel कि ये ठीक है यानी जो हो रहा है वो ठीक हो रहा है.
as Rajesh said very correctly,
Uh,
don't against a central banker.
Yeah.
Absolutely true.
And
Yeah.
as a small investor, you very rarely understand what a central banker
Can
in
do. Yeah.
in the US is doing or what
Hmm.
the impact will
Yeah.
be, you know,
Right. Right.
uh, which is another challenge. But yeah, liquidity is something that is
Yeah.
increasingly impacting markets
Yeah.
more significantly.
I think that is the
Yeah, I
key
think
thing. Yeah.
yeah, I think there's when we were studying in business school, etc., there was a certain model, right? A
Hmm.
global model where markets and economy and all these inflation, not other parameters, all
Hmm.
linked to
Hmm.
employment, unemployment levels, all of that. And I think the relation is very clear. But over the last 20 years, since the mid 90s, I think, and US and other developed markets, and now we see larger emerging market countries also, right, including China, India, etc. I think the central bankers and the governments and people who matter in the past to be have started influencing a lot of these parameters,
Hmm.
right? And all of this influence is coming mostly from the point of view that we as the human race now don't want to see any cycle. We all know cycles. We know the world, the globe moves in cycles, all of that, the sun, the moon, everything moves in cycles. Markets and economies should not move in cycles. We all want to see this nice upward trajectory.
Hmm.
And I think what has happened is if you're deploying capital in the market today, right, and you're using the old model of those very clean, neat relationships, then I think you're completely not getting what's happening in the markets now.
Hmm.
And therefore, it's I think important for all of us to understand, like I said in the beginning, the role central bankers and powers to
Play.
be, not just central bankers, by the way, I have to also add, economies should be run by economists, right, and countries should be run by politicians
Hmm.
or the bureaucracy. I think what's happened now over the last 20 years that we all have to understand is economies are now being run by politicians, and that's really bad news. Right? But there's no way around it. So you can't fight it. You have to be part of it.
Yeah. You have to be
And
part.
therefore, when people say, "Arey, market is doing so much, economy, my business is not doing well,
Hmm.
private sector, everywhere there's a problem." I say, why do you think there should be a relationship between units? Liquidity. It's linked to its demand supply, basic demand
Yeah.
supply, right?
Yeah.
Forget all economics, just economics 101, that curve of demand and supply. It's just too much liquidity in the markets.
Yeah. So on this note, I think we should end this conversation. It's been a great time talking to both of you. It was more of a conversation than any kind of question answer kind of thing. I think I enjoyed it hugely, this whole piece. And thank you so much for actually being a part of this.